It's a special edition of On the Markets. We're talking 351 exchanges with Meb Faber. Who's that? What is a 351 exchange? We're about to find out.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the Markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, and Fermata Tax. On the Markets starts now.
Special edition of On the Markets. My name is Dano, Weir. I'm the marketing director for Sonoma Wealth, Fermata Advisors, our Fermata family of brands. I'm joined by our managing principal, Chris Sipes, CFP, and very excited to have our special guest today. He is the co-founder and chief investment officer of Cambria Investment Management. He's also the host of the Meb Faber Show on YouTube and Apple Podcasts. And we're talking 351 exchanges today. Welcome to On the Markets, Meb Faber.
Great to be here. Thanks for having me.
So Meb, here's a scenario, totally fictitious scenario. Let's just say I got in early on a company that makes chips for AI applications. Can't imagine which company that would be. And that stock position has appreciated greatly. It's feeling a little risky to me, and now I want to get out, but the capital gains are freaking me out, so I'm, quote, stuck. Have you ever heard of that scenario, and how would a 351 apply to that?
I personally never have any capital gains. I mean, I grew up during the 1990s bubble. I think I'm still sitting on my pets.com, a loss for CMGI. That might be a little PTSD for some of the older listeners here, but no, just kidding. Yeah, I mean, look, we often say the tax alpha is more important than the investing alpha. Everyone loves to spend all day talking about what's the Fed going to do. Should I buy gold, or stocks expensive? And in reality, the very simple blocking and tackling of taxes and largely avoiding or deferring them can be orders of magnitude more important than sort of the gains often that people try to seek out on the investing side of the business. So simply by avoiding these or deferring them is important. And so this is one of the reasons the ETF structure has kind of grown to eat the asset management industry. It's just a much better structure than a lot of the legacy products that also happen to be high fee too. So there's some innovations coming on in a bunch of different areas, but one of them being, hey, look, is there a way to do something with these massive capital gains other than just die or donate them? Is there something else you can do to defer them a little longer? And it turns out that sure enough, there is.
Yeah, so a couple options we were going to talk about today, Meb, were 351 exchanges and then exchange funds. Now, how long has this structure been around, like in the tax code? Is this something that's new, or it's actually just been around for a while and maybe people just haven't heard of it until now?
Let me define a few things, because in our industry, there's nothing people love more than jargon, right? So
Yes.
even the ETF, the exchange traded fund, if you were to ask people 20 years ago, what they would say, EFT, is that a funds transfer? What is this? So I think the world, for the most part, understands what an ETF is. It's largely a tax-efficient mutual fund, is the best way to say it. Trades during the day. Everyone knows the tickers. SPY has been around since the 90s now. And the beauty of the ETF is that you buy into a portfolio like SPY, and the ETF structure allows you to rebalance that portfolio, and it's not a taxable event. So whereas for a mutual fund, if you do a bunch of turnover and you have gains, you have to distribute those gains. For an ETF, they get deferred. So the cool part, if you bought SPY in the late 90s, 25 years later, despite all the rebalancing it's done, it's not paying capital gains distributions. Now, you'll still might have some income distribution from the dividends, which are pretty low today. But in general, it's not paying capital gains, even if it's an active fund. So a massive innovation. So that's the ETF. The problem is,
SPY, sorry to stop you, but just SPY would be something that tracks the S&P 500, which is the 500 largest companies in the US. So within that fund, it would own a little piece of all those top 500 companies. And so what you're saying is that originated in the 90s, maybe Exxon was a huge portion of that way back when. I remember you mentioning the whole energy complex got down to only 3% of the SPY, like during COVID. So there's been a lot of changes in the makeup of that SPY over those decades.
Mhm.
However, because it's protected by that ETF structure, all those trades with those different companies did not create a capital gain along the way for the client. Is that correct?
Which is magic, for sure. Things come in like Tesla and Berkshire, things come out over time. And it's really this really incredible structure for taxable investors. And it applies to all the ETFs. You could have active ones trading, and there's some on the periphery that are a little bit weird that will be paying capital gains. So if you're investing in, I don't know, some cash markets like Brazil or Colombia or China, you might end up distributing a little bit of gains. But in general, it's almost universally better than anything else out there. But that doesn't help you if you were lucky enough to have bought the Mag 7 10 years ago, right? Or you were a founder of a company, or you invested, and you're sitting on huge gains, or you did all sorts of different things. From our parents' generation, used to hear the phrase was, "Hey, I bought GE or I bought IBM. I got a 10 bagger, 100 bagger on this. I can't sell it. The tax man's going to kill me." Like, how many times have I heard that? And so I used to always joke with people. I say, well, look, the market's eventually going to solve this one way or the other. And sometimes they watch it go all the way down, right? And so they say, I can't sell it. And then it goes down 10, 20, 50, 70, 90%, which is a really unfortunate and in many cases devastating and unrecoverable mistake. The good news is you now have options. So there's kind of two things you mentioned that have actually been around in the tax code for 50 to 70 years. The first one is a exchange fund, which has traditionally been the province of like Goldman or Eaton Vance. And there's some great features of it, and there's some less great features. The first tough part is you have to be an accredited investor, or usually qualified, which means you got to have a lot of money. Second is that you can contribute assets to this fund, but you got to hold it for 7 years, so not ideal. And the third is you contribute stocks or positions, and after 7 years, you get back whatever anyone else contributed. So for the challenge for a lot of these is you may not want what everyone else is contributing. You may not want to contribute a bunch of tech stocks and maybe get back the NASDAQ in return. And so, and traditionally they've been very high fee. But it's a potential solution for people. And then kind of the new one that we're going to talk about, or so I should say, the new interpretation is the 351, which has been in the tax code for at least 70 years. But it really found its moment, its partner with the ETF structure is really where all the good magic happens.
So I'm gonna set the scenario again. I'm gonna set the scene for someone because we have a lot of our clients and prospective clients who are trying to conceptualize where does this come in and work for me. So you've bought a tech stock, and it was a different time in your life, and you made a great pick, and it's appreciated greatly. But you're looking to get out because you're feeling like maybe it's, you don't like the trajectory, or it's a little too risky for you at this point. Maybe your life has changed. You're worried about the capital gains hit. And now Chris is your advisor. Hey, lucky you. And he says, you know what? We work with Meb Faber, and we have this thing called a 351 exchange. Tell me again, Meb, really, you talked about block and tackling. Tell me again, really basic. What does the 351 exchange do for the person who has that concentrated isometric risk?
Yeah. So if you go back 100 years, and the point of 351 was, let's say, I know we got two folks in sort of farm country where y'all are, where the three of us wanted to start a new business, a new farm, and one of y'all is going to have the tractor, one of y'all is going to have the seed, I'm going to contribute the barn, whatever. You contribute all these assets to a new corporation, and it's not a taxable event, right? You shouldn't have to pay a bunch of taxes on that when you start a new company. And that's really the origin of the 351. And then where it's found its perfect partner in the modern age is with the ETF. And we can get into this maybe with the deck, might help on some of the visuals, but basically it allows you to contribute property, in this case, stocks or ETFs, publicly traded assets, to a registered investment corporation, an ETF, and it not be a taxable event. So it ends up being, hey, you contribute this property, you get the ETF back, and it ends up being a tax deferred event. Now, to be careful, listeners, you're not washing these taxes. That would be illegal. You're not getting rid of them, but simply deferring them. And it ends up being a pretty magical setup.
So you're able to change your risk profile from that isometric risk of that one position, and you're able to spread it out into, if you're looking to go from the concentrated risk to a more diverse risk profile, basically.
Yeah, I mean, I think concentrated is kind of the number one use case for sure. Whether it's a handful of positions, a bunch of positions, one sector, one country, whatever it may be, I think that's a good lead in for sure. All right, we got a beautiful deck. Should I roll through this real quick?
Yeah, take it.
Awesome. So anyway, we're going to keep going one more. Again, the lead gen, you guys talked about concentrated stock. Another part is for a lot of people is they just say, I'm nervous about the stock market in general, maybe. Some people say it's been a hell of a run since 2009, that the stock market's been a 10-bagger. Congrats, pat yourself on the back. But, these romping, stomping bull markets often lead to a place where at the good times eventually end. Who knows? Maybe it's this year, maybe 2030, maybe 2040. I don't know. May never have a bear market again. But in general, the good times lead to things getting expensive. And that's true in the US. This is a chart of 10-year PE ratios going back to the 1800s. Anyway, next chart. And this is something that
Chris loves that. Chris loves any chart that goes pre-1900. He's geeking out right now.
I'm in.
Yeah. But it gives you perspective. And this one, and y'all can look at it later too, it's a well-discussed phenomenon. Everyone on TV talks about this all day long, is you got this, what people call the Mag 7, which is the acronym of this cycle, which is a very concentrated mega cap market. NVIDIA knocking on the world's first $5 trillion market cap company. So you're kind of putting all your eggs in the basket of these highly appreciated positions, and that makes a lot of people nervous. They say, "Man, I don't want my portfolio to be chock loaded with all these positions." It feels a little bit like the late '90s for a lot of people. The next slide. So we kind of referenced this, but here's your dilemma. You say, "All right, you're going to hold it and just deal with it." I'm going to sit through this. I'm going to accept whatever my fate will be. And then the other is, nope, I give up. I'm going to sell. I'm going to pay Uncle Sam, which nobody loves to do, and move on with my life. Call it a day. And those historically have been that's the menu. But if you've ever been to In-N-Out, there's a secret menu. There's a third option, which is 351. So let's
351 is the animal style of finance.
Exactly. So what if there was a better way? Next slide. So, we talked a little bit about this. You can contribute assets, and they got to be, publicly traded stocks or ETFs. So you can't contribute mutual funds, can't contribute your hedge funds, can't contribute futures or options or Fartcoin or Dogecoin, any of that stuff. Publicly traded stocks and ETFs. Next slide. And so this is pretty wordy, but there's two main rules that y'all got to focus on when we're talking about this. And the first one is you can't just contribute one position. So the largest position can't be above 25%. And the reason why is you go back, to the early days of 351, the regulators in their foresight, they said, look, we don't want people doing this for tax reasons alone. So this has to be somewhat diversified contributions. So let's say you got 10 million NVIDIA. You can't just contribute 10 million NVIDIA. You could contribute 2.5 million NVIDIA and 7.5 million something else. And the second rule is top 5 positions can't be above 50%. So what does that mean? The basics are you either need to contribute about 12 stocks or more, or, and this is a giant or, ETFs are pass through. So meaning if you look at SPY, we referenced earlier, that's going to hold 500 stocks. So theoretically, you could contribute 100% SPY, or you could contribute, say, 2.5 million NVIDIA, 7.5 million SPY, whatever it may be. There's a lot of permutations of things that could fit. But for concentrated positions, a lot of people end up contributing, hey, I got these 10 stocks and ETFs, or, I got these 20 stocks, or I got on and on permutations that will get you to where you need to be that makes it okay. It's important. This only happens on the seed of a new fund. This doesn't happen. You can't do this after the ETF launches. After the ETF launches, it's just like any other ETF trading on the marketplace. You can pull it up on your Schwab account, look at it, buy it, sell it, on and on. Next slide. And this was just kind of a good summary on what you can buy, what you can't buy, what you contribute, can't contribute. I think we've already covered this, so we can go to the next one. This isn't our first rodeo, so we've actually done 3 of these. People are always like, I haven't heard of this. Well, don't worry, 99.9% of people haven't heard of this. I've been getting speeches all over the country, certified financial planners, CFAs, family offices, institutions, and people usually respond with a blank stare when you're talking about 351. It's changing though. Our lawyers that have done this have done over 100 of these, and traditionally the way you've seen it is something like a mutual fund to ETF conversion, or somebody says, hey, I'm going to convert my ETF hedge fund to an ETF. What we're doing is this, what we call open enrollment. So, we're allowing financial advisors and their clients to contribute assets to this ETF launch. And when we started doing this over a year ago, we said, we're going to lay out a buffet for 2025. And here's going to be 4 choices. We'll probably do this again in 2026. And so we've done 3 already. Tax was the first one about a year ago, which was a U.S. stock fund. ENDW, which was an asset allocation fund, and GEW, which was a couple weeks ago, was a global stock fund. And they're getting increasingly bigger. So in 30, 100 million, 150 million. And then next up, if you guys could zoom in on my hat, you could see that it's a USEW, which is the next fund. And we can go to the next slide. And so what is USEW? It's a U.S. stock fund. One more slide. And basically, the launch date is going to be mid-December. So before the holiday time, it's going to give you sort of a U.S. Core equity exposure. And we're going to break that market cap link. So going back to the U.S. stock market being expensive, we don't want it to be all of our positions in these giant mega cap companies. We want to get to a place where it's closer to looking to something like the top 500 stocks in the U.S., but more of an equal weight. So instead of having all in on 7 stocks, really you're going to have exposure to the top 500 companies. We're going to allow, it's going to has the ability to rebalance tax efficiently. The expense ratio is about 0.25%, or other call it 25 basis points. So nice and low as well. We do one more slide.
So if just to visualize that, since we're getting close to my favorite holiday, Thanksgiving, and I have 4 kids, Meb, and when you go to divide up a pie, they are watching it like a hawk to make sure that each piece is exactly the same as the other pieces, especially it better not be bigger or smaller than the one their sibling just got. And so that's kind of how I would picture an equal weight, is that you're slicing that pie into equal slices for every company in that S&P versus the traditional, say, SPY. A huge slice of that is going to NVIDIA, a huge slice is going to Microsoft, and there's going to be a little bit of the pie left for the other 493 companies, right? So is that a good way to kind of describe how the equal weight's going to work?
Yeah, so the good hack there, by the way, I don't know how this works with 4 people. Traditionally, when it's 2 kids, you can say, all right, one of you gets to cut and the other one gets to choose. That way,
Smart.
that's the efficient
Smart.
market right there.
I like it.
Well, it's funny, so for clients listening to this, market cap, so when you go back to Jack Bogle and others who started developing the market cap indices in the 70s, like it is the market. That is the true index. And it was a massive innovation because it allowed people to offer products at low cost because they did nothing. True market cap, you buy the stocks and they just float, right? You don't really do anything. The problem with market cap, and you talk to a lot of end investors and you say, do you know how something like the S&P 500, and the S&P 500 is a little different because it's got a committee, but every other index is designed is, it's the largest stocks. But the Achilles heel of market cap investing is it has no tether to fundamentals. So you get a bigger weight as the stock goes up, and as the stock goes down, you get a lower weight, which is good because you own the winners, but it's bad because during the boom bubble times, you put more and more money into the stocks that have gone up the most. And so this is historically speaking, and we have a paper on this on our website. If you could avoid some of the downsides of market cap weighting by equal weighting, or really doing any other weighting methodology, because you break that market cap link. So you don't put the most money in the biggest stocks. So like December 99, the most expensive the US stock market's ever been, that was when the stocks had gone up the most. And if you had done something else equal weight, the next 3 years there was a 50% bear market in the S&P, but for many other weighting methodologies there was no bear market at all. You could look at something that we love talking about, like Japan in the 1980s. Got to the most expensive stock market in the world, but it was the biggest stock market in the world at the time. A lot of people don't know that. They always assume the US was the biggest forever. Japan was bigger than the US in the 80s. And then Japan's stock market went nowhere for decades, right? And so I think there's a better approach, we believe so. And this seems like a perfect opportunity for people to contribute assets that maybe they feel are highly appreciated or expensive, and be able to rotate into something that might be more palatable. There's some timelines. We want to get these done by Thanksgiving so you can enjoy your Thanksgiving holiday and move on. And then the fund will launch mid-December. And one more important comment, and then we can move on to whatever else, is that, when you get the ETF back, and let's say you contributed 20 positions, the cool part is you now have 20 separate cost bases to manage. So you could pick and choose which ones you want to sell in the future. So it gives you very granular tax optimization. It doesn't have to be all or nothing in the future.
Yeah, and so kind of the mechanics of how this works, and stop me if I'm wrong anywhere in here, is that you're going to take those appreciated positions that you already have. Your team at Cambria will map the tax using our help, showing what the tax lots are of those positions that we're contributing. You map that over so that the new taxable position in the new ETF, you're in the same position as you were before. It's just you're going from concentrated risk to more diversification. That's really the main benefit. You get to continue to defer those taxes down the road. But your team does all that kind of underlying work with that tax mapping, correct?
Yep, that's it.
And is that a big reason why 351s have not been, kind of brought to the public before now? Is it just that Cambria has been willing to kind of step out there first and do the work to do this? Because it is a lot of work.
There's a couple things. So they have been done, but traditionally it's done where like Dimensional Fund will convert 100 billion of their mutual funds. And that's kind of simple because it's their fund, it's their assets, they can control it. The innovation that we've kind of pioneered with our friends at ETF Architect is saying we're willing to open this up to various advisors. Now, why hasn't BlackRock done this? Why hasn't Vanguard done this? And I think they probably will at some point. I think there's two things. One, they got 4 commas in their total assets. When you manage $1 trillion, you're not going to mess around with something that's a ton of work for not a ton of benefit, and then they got to roll it out to everyone. It's just, it's a giant plumbing problem for them if they're dealing with millions of accounts, and it's getting much better. A lot of the custodians, depending on where you are much more set up and on board with, kind of streamlining this, but software solves most of this. And it's getting better on each launch and smoother. But the main reason is just it's a lot of work and it's manual still. You're talking to a client and it's a process. And so thankfully we have y'all to help us, and we have ETF Architect to help us, and on. But I think and also the biggest hindrance is, as you guys know, with money, there's a lot of inertia and people are very wary. Look, and as they should be with their hard-earned nest egg, to go do something that sounds new, right? And the good news is now we have a fair amount of prior art. We've launched 3, and ETF Architect has launched a handful as well. So it's becoming more mainstream. But again, like we mentioned earlier, 99% of people have not heard of 351. But the good news is if you Google 351 ETF, you'll see articles by Bloomberg and the Journal and CNBC and everyone else covering it. I think next year it'll start to hit more mainstream. I think the struggle for a lot of people is, when does this wild romp end? It feels like what's the classic line of the punch bowl at the party? We don't know when it's going to end, but one day it might. And I think, a lot of people are nervous with these big gains they got.
Yeah, Meb, I'm so glad that you touched on the hard-earned dollars piece of it, because when Chris was first, this is new to me that I've been learning about here at the firm when he was explaining how this all works. And my connection to a lot of our clients is I'm kind of I ask a lot of the questions that someone who's never heard of things like this will ask. And so I immediately, when Chris started explaining it, I like to call this stuff double backflip finance, where it's like, it feels like you're like doing something like that. So I guess my question is, tell me about the process. Tell me about the people. Tell me about how often you've done this. Tell me it's new, but you've been doing it for a while. And you mentioned that the code goes way back. So can you just tell me about, some success stories, or what can you share with me regarding kind of some case studies with people like this?
They're getting bigger and bigger. And I mentioned our first one was 30 million. Our last one was 150. I think you'll see some that are going to cross over $1 billion in short order. Goldman did one. People always joked on our first fund. They're like, "Meb, is this real? Is this legit?" I said, "Well, Goldman just did one, and Goldman's got way more expensive lawyers than we do, and ours already are expensive. We pay them a fortune." Goldman did one, but they did it with their own money, right? They weren't opening it up to all you and me. And so there's been a bunch of these, and you're going to hear more and more about it. It's kind of like, once you've heard it, you can't unhear it.
Mm-hmm.
The very tax sensitive people, traditionally family offices, are on the forefront of being interested in this. A lot of and this is great for y'all, by the way, because the old traditional wirehouses of the world, their advisors are going crazy wanting to do this, but obviously they can't, because Merrill and Morgan and UBS, those risk departments are taking forever. Plus, on top of that, they got a lot of conflicts on being able to do it. So that's the beauty of y'all's model. So I think it's like anything, a new product adoption, where the more you see, the more comfortable people get with it.
Mm-hmm.
It's probably a great rule not to be the earliest adopter when it comes to money and trying something out. But and I think it'll also increase depending on what's going on in the world. If you start to see a little volatility and jiggles, or even a downturn, investors start to get pretty anxious. As long as, if the S&P is doing, and we said this earlier, said this is only one of 4 times in history where the U.S. stock market's done 15% a year on a rolling 10-year basis, and said the other 3 have names: the Roaring 20s of the 1920s, the Nifty 50 period of stocks, which kind of not too dissimilar from today, of the 1960s and early 70s, and then the internet bubble, and then the COVID meme stock mania. And so it's been an amazing time. But imagine if the U.S. stock market stops doing 15% a year. Well, all of a sudden people are saying, "Uh-oh, I got to get out before this game of musical chairs ends of this position," that, as you mentioned, like, you don't want to be there when it's down 90 and you missed it. So I think the increasing interest will start to happen.
I think I heard the quote from you, Meb, that it's, you may concentrate to get rich, but you want to diversify to stay rich. I don't know if you're the one that said that. I feel like I heard it from you.
Take credit. Well, say it was you.
Yeah.
It's a good saying.
We wrote a series of 4 posts in the COVID pandemic 5 years ago, talking about the get rich portfolio, the stay rich portfolio, investing in a time of Corona, and kind of what I do with my own money. And we were talking about some of these topics, but the thing about concentrated stock is that the people that have made money with investments or concentrated investments. So let's say you hit the lottery, you had bought Nvidia 10 years ago, or Microsoft, Berkshire, whatever. You have a very small subset, hindsight bias. You were the successful one, right? And if you look at the long distribution of stock returns, roughly 2/3 of stocks underperform the index, about half essentially have no return, and about a quarter basically go to zero. And the thing then with concentrated stock going forward is everyone's like, yeah, but I made money on this stock. It's my baby. It's like but here is the great behavioral question to ask people. Say, okay, you got 10 million and it's in Nvidia today. God bless you, pat yourself on the back, whatever. Let's say you can magically sell it, and then all right, now you magically sold it, you paid no taxes, you got 10 million cash, okay? You wake up tomorrow. Would you buy with your entire account $10 million of Nvidia? There are zero people that would do that, right? It's this endowment.
I don't know about zero, Meb.
It's called the endowment effect. And here's a great way to make the analogy to investors. You put way more value on what you currently own than something you don't own. That you can do this with a coffee mug, or you can do this very simply. You can walk out to your garage. If you guys don't have a garage, you can walk into your closet and take inventory and pretend tomorrow that your house burned or whatever, someone got rid of all the stuff in your garage, got rid of all the stuff in your closet. Would you go buy all those things again? Of course, no one would. No one would go buy that old riding lawnmower that doesn't even work. No one would go buy the old sports kids equipment, which, your kids are now 16. This is like from when they were 5. So why do you keep it? Why don't you sell it? Is because people put a value on things that they already own. And this is true with stocks too. So I think it's mentally cleansing to move on. But all the academic research shows that holding a concentrated portfolio going forward is a terrible, horrible, no good, very bad idea. You may be the outlier on 1 in 100 in the future on what does well, and good for you if you do. But on average, it is, and you can ask the Enron folks, you can ask there's thousands of examples of giant companies that are no longer giant.
You mentioned, and Meb, I just want to be really clear on this, because you mentioned that Goldman had created a fund like this, and then you mentioned that your fund is for you and me. So when you say you've got 30 million in the fund, these are individual investors. These are like, for example, Chris's clients could be in there. The average retiree, this is something that they have access to through you.
Yeah. So the last fund we did was 150 million, and the traditional path is you have to go through a financial advisor. And why is that? That's actually not an us requirement. I would love it if it's just open to everyone in the world. I love democratizing investing. I want everyone to be an investor. We got a new book coming out next year that's targeted at this topic called Time Billionaires. And so, but the custodians like Schwab are like, oh no, we are not dealing with 10,000 people trying to do this. Like, this is not on our plate. So they say you got to go through an advisor, which it's kind of like the white glove hand holding. But yeah, we end up having quite a few different and varied portfolios and ideas and things that people contribute, and it's pretty fun to see what comes in. And you would expect it to be all NVIDIA, but it's not. It's a wide range of positions and portfolios and ETFs that come through.
So you don't have to be accredited, which some may know what that means. Essentially, you've got a high income and or high enough assets to have the powers that be say, yes, you can do this. You don't have to be accredited, but you do need to go through an advisor. Is that correct?
Right. Exactly. Now, the reality is, if you're a young person and you had big gains and your portfolio is only like $100,000, you may want to be taking, the gains now because you don't have high income, or you don't have, your tax rate's lower than it may be in 10 or 20 years. So on average, we're not getting people with lower account balances. Sometimes they're like, I don't even want to deal with it. It doesn't matter. On and on. I'm not paying much in capital gains. So for each person, but for the people who are in the much higher tax brackets, that, and in some cases, we talk to investors, they're like, look, I want to move into a portfolio that can rebalance and move on. I don't want to have to think about it. And you know what? This sucker is going to my heirs at death, or I'm going to donate it. Like, there's all sorts of different use cases. But on average, I think that people tend up having kind of larger portfolios just because, for various specific reasons.
You mentioned previously crypto, and that is definitely a space where people may have an appreciated position. You also mentioned fart coin, which, if anybody doesn't know, that is actually a real coin. Meb was was speaking to truth. Don't go look for it. So how does crypto and 3451 exchange play with each other, or don't?
So one important note is, people ask us, hey, like, what type of funds are you doing? And when we did this about a year ago, we said, we're going to lay out a buffet of 4 choices. We're not sure what people want, because some people, say, hey, I'm getting out of this. I may want that. I may want something else. And we'll do a similar buffet in 2026, I believe. But you can only contribute assets that are similar to what the fund is going to be doing. So our next fund in December is a US only stock fund. So you can't contribute foreign stocks, you can't contribute a gold ETF or a Bitcoin ETF or whatever. For other funds that we have that might be multi-asset, you can, right? And so it, on average, it's got to roughly match what you're trying to do. So but I think in 26, you may have the ability to contribute Bitcoin and some other interesting types of assets that really this year you probably couldn't. But for now, it's mostly U.S. stocks as well as ETFs.
So just to be clear, if you're getting out of that concentrated position and going into the 351, you have to purchase, you've said this one, I'm going to be clear here, you have to purchase like positions. So if in this case you were leaving crypto, you would have to go into crypto. If you were leaving international, you would have to be going into international in the 351. Yes?
Broadly speaking, correct.
Or a fund that holds all of those. Like earlier this year, you did the endowment fund, which didn't hold
That'd take
crypto.
Anything. That's all
Yes,
the world.
it didn't hold crypto, but it held a lot of other assets, and so you were able to contribute, foreign stocks, U.S. stocks. This year we've seen a big run in gold, so I'm sure you're going to have some people with looking for diversification options there too. But that's a good question, Dan. So, but you couldn't take like crypto and go into a U.S. stock fund. That's not going to work.
That would not be my interpretation. I think there are other people out there that could come up with all sorts of different interpretations of what the rules may be, but that would make me a little squeamish.
And probably those lawyers too.
Yeah.
Well, Chris, we are getting to the end of our time with Meb. I know you have, Chris always has more questions. So out the door, Chris, before we wrap up, what else do you want to ask him about 351 exchanges?
I know you've done a couple other podcasts, Meb. Where can people find out more if they want to dig into some more details? What would be some good resources for them?
The first one is we have a page on our website, cambriafunds.com/351. If you just Google 351 ETF, there'll be a number of webinars and things that we've done and others have done on the topic. And always reach out to us. Reach out to you guys, but you could also reach out to us, and we're happy to answer questions.
We thank you so much for checking out our show today, this special edition of On the Market. If this is you, if any of this has been resonating, if you've had a position that you have not been able to rebalance, if you've been finding yourself feeling squeamish about the future moving forward in the market and you're looking for a little bit more diversification, this might be an option for you if you're a client of ours. Contact your advisor, contact Chris, sonomawealth.com if you are a prospective client, if you want to learn more about what we can do for you and how a 351 might be helpful. He is Meb Faber, the co-founder and chief investment officer of Cambria Investment Management. He's also the host of the Meb Faber Show. So if you're enjoying the conversation today, make sure to find him on YouTube and Apple Podcasts. Just search for Meb Faber. Details on Cambria Funds at cambriafunds.com. And Meb, thank you so much for the conversation today.
was a blast. Thanks for having me.
Thank you, Meb.
You're up to date with Fermata on the markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Ellaway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.